So in this video, I'm going to show you the real reason price sweeps a level, reverses and leaves most traders stopped out and confused, while the smart money steps in for perfect entries. We will break down inducement liquidity and liquidity sweeps in a way that makes sense, even if you've struggled with the concept before. By the end of this video, you'll know exactly how to spot these traps, avoid getting caught in them, and instead use them to your advantage. So go ahead and smash the like button, subscribe, and turn on the notification bell to get notified anytime we drop a new video. Now, before we get into the advanced concepts, we need to fully understand what liquidity is. So, what exactly is liquidity? So, when you look here, you can see a clear price rejection. This rejection tells us that business was conducted at this level. The prices couldn't break through and sell orders came in. This creates a pool of liquidity, an area where buy and sell orders are resting. When price returns to that zone and runs through it, we call that a liquidity run. But in this video, we will limit our focus on the concept of liquidity sweep and inducement. Here's the difference. Imagine liquidity has been engineered. You've got equal highs around here, and the price breaks out of the range, but instead of continuing up, it pulls back inside. That return inside the range forms your liquidity sweep. Think of liquidity as a place where business took place, like the buying and selling orders, for example. Let's say you have a swing point here, then the price revisits it and rejects. This tells us that sell orders were active here. And that's not just institutional orders, but many retail traders sold at this level too. Their stop loss is placed right above that point. This makes the area a valid liquidity zone, even if they didn't sell right there. Maybe they even sold later around this level. Their stop loss will still cluster in that same region, above this high. So when price revisits the zone, it often cuts straight through, taking out liquidity built at the level. From there, price might continue upwards, making a liquidity run, or reverse back into the range for a liquidity sweep. Here's a support and resistance liquidity example. Here you can see that a rejection forms, and the level pulls price in like a magnet. Now let's take it further. Say you have a swing point here, and another swing point here. They're not equal, not even close. But what's their relationship? The second swing is simply a reaction from the first swing, likely from an order block or supply level. When that reaction happens, institutions aren't the only ones trading. Retail traders also jump in, buying at various points. Their stop losses rest below, marking your nearest liquidity zone. So how do we use this? So you will just mark that swing point, and when price approaches, expect it to take out liquidity. If price enters your premium zone, it's more likely to clear the level than reject internally. From there, the price could either keep climbing or sweep liquidity and drop. Now, what's inducement liquidity? So, inducement liquidity is essentially a trap that gets trader to enter the market early, only to be taken out later. Say you've got a supply order block as your entry point. The trend before was bearish, and you're planning to sell when price hits that level. The smart money institutions know it's cheaper to move the price from that level, but they won't give retail traders an easy entry. Instead, they fake the price. So the price pushes close to your point of interest, then reverses early. The retail traders would think that this original level is invalid, so they switch focus and start seeing this level as a new and valid point of interest. When price breaks structure, the traders would sell early with stop loss just above their entry. But price then pushes higher, hits the original point of interest, and continues the bearish move. This results in early sellers getting taken out. That inducement zone becomes liquidity. Its purpose was to lure traders into the market too soon. Here's an example combining inducement and a liquidity sweep. Let's say that the point of interest is here, but then the price first forms a false swing point here, that is the inducement. It then moves to the real point of interest, reverses, and then sweeps liquidity. This then forms the liquidity sweep or the purge. Another variation of inducement liquidity involves the support and resistance liquidity. Let's say we have a clear supply zone around here, and then the price forms a rejection multiple times around here, creating equal highs. These equal highs form the inducement liquidity. Then the price later runs back to the point of interest, clearing out those equal highs, then reverses. The liquidity sweep here is this price purge. Now, here is another example. So, let's say we see this demand order block as our valid point of interest. Then the price formed this equal lows here, setting the trap for inducement liquidity. The price rejects, inducing early buyers into the market, then came back later to target the demand block before expanding. Now, how do we find the perfect inducement? You might be asking. First, identify the swing level you want to be targeting. That's your point of interest. Then pull out your Fibonacci tool and then define your range. Start from the previous low before the range break, then mark your new high. Again, this should be your fib levels: 0, 25, 50, 75, and 1. This premium zone is for selling, and the discount zone is for buying. The institutional players prefer selling at the premium and buying at the discount. If the inducement happens inside the discount, it creates a high probability trade. We don't want inducement too close to the point of interest. If price taps that level multiple times, the sweep may fail. The inducement can be equal highs, a fake swing, or a false supply zone. The price will then take out that level, retest the discounted order block, and then continue expanding. This right here is your liquidity sweep, the purge. When the fib is removed, you see the inducement liquidity, the sweep, and the discounted demand zone clearly. Now let's check out this example on a real chart. Here we have a major break of structure. You can see that this swing high was broken, and we have the previous low intact. Once the price returns inside the range, we then draw the Fibonacci locking in the high and low. This discount now becomes the key buying zone. Then just mark out the 50% for context, but we will focus on discount since we are in an uptrend. We wait for inducement to form away from the extreme discount zone. You will mark this swing point as the inducement level when price takes out this inducement, and then taps into the demand zone. Then you will place a long entry here before the expansion into this swing high. This right here forms our liquidity sweep. This means that the early retail buyers are trapped. Smart money waits. Once the sweep happens, price continues the bullish trend. Notice how long the trap can last. Consolidation and rejection are all designed to set up the inducement liquidity and liquidity sweep. Now, if this video hits 1,000 likes, I'll create a full strategy breakdown, covering timeframes, best setups, and every detail for trading liquidity sweeps. If you want to integrate this into a complete strategy, you can subscribe to the channel so that you can watch the next videos that will be coming to the channel to keep building your skills. This broker right here is one of the best Forex brokers in the Forex industry that offers both Forex and synthetic pairs. If you want to trade correctly and not miss any market move, this is the right Forex broker for you. So click on the link in the description of this video to register with the Derive Forex broker and trade efficiently. Go ahead and join our Telegram channel and get access to high-quality expert curated trade signals every single week. But that's just the beginning. For those who want even more, our VIP signal channel delivers the most premium signals with even higher accuracy and more frequent trade opportunities. Don't settle for average trades. Join a community that wins consistently. So, click on the link in the description below to join now and start capitalizing on the market like a pro. If you found value in this breakdown, do me a favor. Hit that like button and subscribe to the channel. Your support helps us to keep sharing these advanced trading insights on YouTube. Still have questions? Drop them in the comments and I'll personally help you out. And stay tuned. I've got another powerful concept coming up in the next video to take your trading even further. Until then, trade smart, stay disciplined, and keep learning.